Up to this point, we've been learning individual tools, but tools alone don't create consistency. Consistency comes from discipline, following clear rules and executing a system the same way every time. Phase 1 was about building a foundation and understanding how the market works. Phase 2 introduced the core concepts needed to start executing with intention, and today we're going to bring it all together. I'm introducing my system, the Zenith Model, the framework that ties everything we've covered into one structured approach. Welcome to Phase 3, Lesson 1. So how does my model work? It's a process that can be viewed as like a checklist. At its core, the model answers 4 questions. Which direction is most probable? Where do I expect price to react at? What confirms my expectation? And where is price likely going next? So let's get into it. It all starts with identifying the bias on the daily chart. I begin here because it represents the highest time frame trend that can directly impact my trades, especially if I'm on the wrong side of it. If you've watched my daily bias lesson, you should already know how to identify these. Typically, when the market opens in the evening, I mark the current daily bias along with the daily target. For this example, we'll just use yesterday's daily candle. In this case, price closed as an inside bar, and if you've watched the video, for an inside bar, you inverse the previous bias. So the day before closed above previous day high, indicating a bullish bias. And then we have the inside bar, so the next day will be bearish. You can use a horizontal ray to label the bias. The way I label it is with the day, D for daily, and then the bias, so bearish. Once I have this labeled, I'll also change the text color to red just to match the bias. The only other thing I mark is the daily target, which is simply the previous day's high or low. Since the bias here is bearish, the target becomes the previous day's low. After marking this on the daily chart, I'll drop down to the 4 hour in the morning to review what price did overnight. The key factor for the overall bias is where and how the 6 a.m. Eastern 4 hour candle closes. There are only a few scenarios that determine whether price continues or reverses from there. And just a quick note, I only trade the New York morning session, specifically the 10 a.m. to 2 p.m. Eastern 4 hour candle or 9 to 1 Central. If you ever see me in a trade during New York PM or Asia, it's usually because the trade originated during the New York AM session and just hasn't reached the entry or target. Once you're on the 4 hour chart, we can begin identifying the overall bias or narrative for the trading session. There are 3 possible scenarios that determine whether bias remains the same, continues, or reverses. The first scenario is an unchanged bias. This simply means that if the daily bias is bullish, the overall bias remains bullish. This happens when price fails to sweep the daily target before the 10 a.m. 4 hour candle opens, which in this case is exactly what happened for the day. The daily bias is bearish, so the target would be previous day low, and price failed to reach that by the 10 a.m. candle. If the daily target is taken, we move into scenarios 2 and 3. In scenario 2, price takes the daily target and closes beyond it. At that point, our focus shifts to how the 6 a.m. 4 hour candle closed. Whatever bias the 6 a.m. candle closes with will take precedence. For example, if price takes out the previous day's high and closes above it, but the 6 a.m. candle closes bearish, we shift from a bullish bias to a bearish one. Scenario 3 occurs when price takes the daily target but fails to hold beyond it, closing back inside the range. Using the same example, if price takes out the previous day's high but closes back below it, that signals a bearish bias regardless of what the 6 a.m. candle bias is. As long as price closes back below the previous day's high in this example, the bias will flip to bearish. There are a couple of important details to keep in mind though. If the 4 hour close doesn't align with the overall bias we've just established, price will typically do one of 2 things. This can occur on scenario 1 or 3, but for both I'll use the same example with the bullish daily bias. In scenario 1, previous day hasn't been taken, so we're bullish no matter what. But if the 6 a.m. candle closes bearish, what do we do? Well, the first possibility is a sweep of opposing liquidity before continuing in the direction of the bias. So we would need the 6 a.m. 4 hour candle's low to be swept before looking for setups to go long. The other possibility that could avoid the sweep is if price forms a new 15-minute fair value gap or order block during the 10 a.m. 4 hour candle. In scenario 3, the possibilities are the same, it just looks a little different. For instance, if we did sweep previous day high in that situation, but we closed back below, and the 6 a.m. candle closed bullish, our overall bias would now be bearish, but since that 4 hour candle closed bullish, we would need the sweep or a new fair value gap or order block made. That's the bulk of the work. Once that's done on the 4-hour chart, I simply drop down to the 15-minute chart after the 10 a.m. candle opens. From there, I'll identify where price currently is and mark the nearest fair value gaps or order blocks that support my direction. I'll usually label it 3 to 4, so if price moves through some or invalidates one, I already know where the next level is. And at that point, there's not much left to do except wait for price to tap into one of those areas, while staying aware of any new ones that may form. If you haven't heard of time frame alignment up to this point, it simply means choosing the time frame you execute on versus the one that supports your trade. While many traders use the 1-minute chart to execute on 15-minute levels, for instance, I prefer using the 3-minute. It produces fewer setups, but better structure, which usually means trading less and winning more. Waiting until price reaches the fair value gap or order block before dropping down to the 3-minute also helps prevent impulsive entries and allows new levels to form if needed. On the 3-minute, after price taps in, look for a change in the state of delivery. If one doesn't get triggered, continue identifying the new change in the state locations as they form, as long as your support remains valid. You don't want a fair value gap or order block to inverse without you knowing. If it does get invalidated, move to the next level. Support comes first, and then the change in the state. If you use SMT as well, it can be confirmed before the change in the state, though I don't personally require it. As you can see in yesterday's situation, the 6 a.m. candle actually closed with a bullish bias, so we would label this as buy-side liquidity needing to be swept, or a 15-minute fair value gap or order block needing to be generated. On the 15-minute, this is the first fair value gap that was formed after the 10 a.m. Eastern 4-hour candle opened, since it didn't sweep the liquidity above. Price taps into the fair value gap, and then drops down and causes the change in the state. If you've made it this far, this is what a valid setup being triggered looks like, but we're not done just yet. In the last lesson, we covered Fibonacci tools for a reason, and this is where they come into play. So from this point, we would plot the Fibonacci from the start of the move that caused the change in the state to the end. So you'll go from low to high for longs or high to low for shorts. If price keeps expanding though, just adjust the Fibonacci until price retraces into the entry level. I typically do this as price closes in on triggering the change in the state, but I don't set a limit order until after the confirmation. The candle needs to close across the open to confirm the change in the state. I'll immediately place the order using the long position tool or short position tool after setup is triggered. This way, in the event the retrace is quick, I'll be tapped in. If price expands and the entry changes though, just adjust the orders. Once your orders are set and price taps you in, you'll switch over to the Fibonacci extension tool. The first 2 points are the same as the retracement, and then the third goes to the deepest part of the retrace. Since the trades come from a fair value gap or order block, your targets will follow those structures. For order blocks, use level 1 and 2 for targets, and for fair value gaps, you'll use level 2 and 3. From there, you'll wait for price to hit TP1 or your stop loss. At target 1, you can either exit the trade fully or partially, trail your stop behind 3-minute fair value gaps, or move to break even if there's none available. I typically take 1 to 2 trades per day. If price reaches TP1, I consider that trade valid, and whether or not I profited from it, I'll stop trading. If the trade loses and the 4-hour candle's still open, I'll look for one more setup, and regardless of the outcome, I'm done. Before I end this lesson, there's a few notes specific to my model to keep in mind. First, if a setup triggers during New York AM but doesn't retrace before the 4-hour candle closes, it's still valid and can be taken later during PM or Asia. Second, if a new setup forms before price reaches the prior setup's entry, you can take the newer setup instead. Lastly, if price sweeps both the high and low, you don't need to skip the day. Instead, you can mark the current daily low or high and use it as the new directional target to guide bias moving forward, using the same logic and scenarios on the 6 a.m. 4-hour candle. For instance, if daily is bearish and before the 10 a.m. opens, we sweep previous day low and then previous day high, but close below it, I would consider this a bearish example since the most recent daily liquidity swept was the high and it closed below. The same logic applies in reverse depending on the direction, but the main focus should be on how the 6 a.m. 4-hour candle closed and where. I hope I've clearly shown how I view the markets, how my system works, and how all these concepts fit together. I also run a Discord community called The Summit, focused on helping traders grow. If you're looking for like-minded traders, have questions, or just don't want to go through this journey alone, you'll find the link in the description. I've got plenty more planned for this channel, and I'd truly appreciate your support by subscribing, liking, and even sharing with others. Thank you for making it this far. What started as just an idea has turned into countless hours of work that I've managed to build into something that I hope helps you grow. I wish you success, and I hope you become the best version of yourself possible. I'll see you guys in Phase 3, Lesson 2.